Revenue versus profit, the illusions. Again, you can have a $100 million business showing $100 million in annual revenue as big losses. That on paper, that means, what does it mean? You know this by now. Negative repayment ability if you have negative net income, or a net loss is what that is. So, it's not all revenue just is indicative of strength. You could have 50 million in revenue and have big losses. You could have 50 million in revenue and have enormous profits. You could have $1 million business that has more profits than a $100 million business. So that the loan affordability is going to be measured similarly. Can you afford the debt service on the loan? Well, the higher, more profitable. Now you might be bound by a percentage of annual revenue for exposure, so that the financial instrument or that facility might have an amount restriction based upon your annual revenue. But your ability to service it, you could be eligible for a larger loan than a $100 million annual revenue company and be $1 million revenue company, based upon, again, the difference between that revenue, the profitability, the net with add backs, the ordinary business income plus the interest, depreciation, and sometimes officer compensation, depending on the institution. You can ask that question. Are you considering my officer compensation? And a lot of times they will isolate its officer compensation in excess of your personal obligations. So you're paying yourself $100,000 a year. You have $50,000 a year in annual expense personally, dictated and illustrated on your personal credit profile. You have $50,000 in excess officer compensation. That can be added back because you could have allocated that differently. And so they do consider that, which is great in your favor. So understanding that not all revenue is created equally, or that just because you have more revenue does not mean you're eligible for more capital. It's the profitability, that magic debt service coverage calculation. That's where you're being determined if you can service and afford debts when we go into a full underwrite. Smaller dollar amounts, they might just look at bank statements and last filed tax return and not even consider the interim financials. So you're looking at your bank statements, your last 6 months, you're trailing 6 months instead. The larger loan amounts, they're concerned about the margins of it. And they look about regularities and irregularities. Do we show this big jump in a certain category, an expense, and cost of goods sold? We saw it shot up 30% this year. What would cause that? So just be prepared for that. And you can front run these elements and attributes and occurrences. And that's the best practice. To be proactive, explain them away. Now they're not surprises that you need to explain. It's the best practice in the application. I understand I had a slight reduction in revenue this year. I eliminated a client of mine that was great from a revenue perspective, but from a margin perspective wasn't great. So the ROI wasn't there. I made a smart decision to reduce that account and make for a better, more efficient firm so I could grow more profitable clients. That's a fair explanation. But when they find it, as opposed to us front running it, it's perceived differently. So again, important to understand that cash flow, the revenue versus profit. At times how you can have a $100 million annual revenue business. Not that it's an illusion literally but it's not the strength that you might think just because it's a big number. And those are the quality metrics that banks and institutions are looking at to understand if you're eligible or not.